Hey everyone, welcome back to Corporate Decoder. Today, Tenon updated us on a big offering they just closed, and I'm seeing a couple of key details you need to know. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about how Tenon Medical just raised a bunch of cash, but the devil is in the details of how they did it and what it means for future stock price. So this is a report from Tenon Medical Inc, a company that makes medical devices. They just announced they completed a public offering of their stock and warrants. Think of it like selling pieces of the company to raise money. They actually sold shares and also rights to buy more shares later called warrants. This filing is a Form 8, which is basically a heads up to investors about important company events. In this case, the big event is their fundraising. They signed agreements to sell shares on the 29th of June 2026, and the actual sale, or offering as they call it, happened on the 1st of July. They sold a lot of shares and warrants in this deal. They offered shares in something called pre-funded warrants, which are basically shares you can get right away, and then common warrants, which are options to buy more shares later. The price for a share and a warrant together was 38 cents. If they decide to do a stock split later, which means making each share represent a smaller piece of the company, but increasing the number of shares you can buy with these warrants will actually go up. So they brought in about $4.2 million before they paid off their agents and other costs. What are they going to do with this cash? They plan to use it to pay off some of their debts that they owe from money they borrowed before. They also want to spend it on growing their business. This includes teaching doctors how to use their current products, hiring more salespeople, expanding where they sell their products, doing more research to get insurance to cover their treatments, funding new product development, increasing their inventory and manufacturing capabilities, and other marketing stuff, plus just general company operations. There is a pretty standard rule in these agreements that stops the company from selling more stock or kinds of stock that can be easily turned into stock for about a month after the offering closes. They can't enter into deals that change their stock price based on how the market is doing for about 3 months. However, they can do something called an at-the-market offering, which is a way to sell shares slowly over time, after that first 30-day period. To help sell all these shares and warrants, they hired a company called Warrants Capital LLC to be their placement agent. This agent helped them sell the securities on a best efforts basis, which means they tried their hardest to sell them. For their work, the company paid this agent a fee and also gave them warrants to buy more shares themselves. They paid the agent a fee of 6.5% of all the money raised, plus another 1% to cover expenses, and they reimbursed them up to $65,000 for their costs. On top of that, the company gave the placement agent warrants to buy about 331,000 shares of common stock, which is 3% of what they sold in the offering. These warrants have an exercise price that is 20% higher than the offering price. Let's talk about the warrants themselves. The common warrants can be used pretty much right away to buy a share of common stock for 38 cents each. They will expire 5 years after they can first be used. The people who bought shares in the offering got warrants to buy 120% of the shares they bought. The price and number of shares for these warrants will change if the company does things like give out stock dividends, split its stock, or combine its shares. The pre-funded warrants can also be used right away to buy shares for a very low price, just 1/10 of a cent, and they can be used for free essentially, meaning you don't have to pay extra cash to use them. There is a limit on how many shares someone can own if they use their warrants. They can't end up owning more than 4.99%, or potentially up to 9.99% if they choose of the company's outstanding shares after using their warrants. They can increase this limit to 9.99% if they give the company at least 61 days notice beforehand. This is a way to prevent a single investor from gaining too much control of the company just by using their warrants. The shares and warrants were offered under special registration statements filed with the SEC. These are like official documents that allow the company to sell its securities to the public. The main registration statement became effective on the 29th of June 2026. The company also put out press releases about this offering. One on the 30th of June announced the pricing, meaning they set the price, and another on the 1st of July announced that the offering was officially closed, meaning it was completed. And here is a list of all the documents they filed with this report. You have the placement agency agreement, forms of the warrants, the purchase agreement, and those press releases. Finally, the report is signed by Stephen M. Foster, who is the Chief Executive Officer and President of Tenon Medical Inc. He signed it on the 2nd of July 2026. Now, looking at this offering, Tenon Medical Inc. needs cash, and they got it from investors who bought shares and warrants. They raised $4.2 million, which they plan to use for debt repayment and business expansion. The price for a share and warrant package was just 38 cents. This is a very low price, and it comes with warrants, which can often lead to more selling pressure down the road as people might exercise them. We see in the research context that the stock price has been very low, around a penny. And it is a warrant we're talking about here, TNONW. The significant institutional holders are also interesting, with Heights Capital Management and AQR Capital Management holding large stakes. Also, this offering seems to be aimed at retail investors given the low price point and the nature of warrants commonly bought by individuals. The fact that they are issuing warrants to their placement agent is also standard practice, but means more potential dilution for existing shareholders. The 4.99% ownership cap on warrant exercises is a common feature to prevent hostile takeovers through warrant conversion. The key takeaway here is that Tenon Medical Inc. has successfully raised capital, which is good for their survival and growth plans. However, the terms of the offering, particularly the low price in the issuance of warrants, suggest they are in a difficult financial situation and are willing to dilute shareholders to secure funds. Historically, companies that do these types of dilutive offerings, especially at such low price points, often see continued pressure on their stock price. A comparable would be seeing companies like Tupperware or Bed Bath and Beyond over the last few years, where repeated capital raises, often with warrants, were a sign of distress and preceded further declines. For example, if you held a $1,000 position in a company like that before a dilutive offering, you might see your stake decline by 20 to 30% in the following months as new shares flood the market. What I am actually looking for is how effectively they can use this capital to turn the business around and achieve profitability without further diluting shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.